Okay, class. Good evening, everyone. I welcome you again to another financial reporting class.
Evening, sir.
Yes, good evening. And today we are going to be starting a brand new topic in the name of IFRS 16 on leases. IFRS 16 on leases. So we successfully finished IFRS 15 on revenue and IS 10 on events after the reporting dates last week. Now, today or this week, we're going to finish up IFRS 16 and also we're going to finish IS 10. I said IS 10, IS 8 on accounting policies, which we are going to do in our morning class, our 10 to 12 class. Then in our evening class, we would finish up IFRS 16 on leases. So let's go straight to what we have for today, considering that our period has been cut short. So leases, IFRS 16. Now, the first thing we need to look at is for us to establish what is a lease. That's what we need to understand. And who is best at explaining that, if not IFRS 16 itself? And IFRS 16 says a lease is a contract or part of a contract that conveys the right to use an asset to another party in exchange for a consideration. So a lease is a contract or part of a contract that conveys the right to use an asset to another party for a period of time, in exchange for a consideration. So a lease is a contract, or it can be just part of a contract. So we could have a contract where leases are just parts of that contract. And this contract is a lease contract if it conveys the right to use an asset to another party for a period of time in exchange for a consideration. And this is a situation whereby the owner of an asset gives his asset to another party to use for a period of time. And of course, the person using the assets would pay. He will pay some money to that owner for allowing him use his asset. So lease is what we popularly call rent or what we call hire purchase. For us, we see all of these as lease because we account for them the same way. From this definition, there are two parties to a lease contract from the definition given above. And the parties to a lease contract would be the lessee and the lessor. The lessee is the party that has the right to use the assets, the underlying assets. While the lessor is the party that conveys that right to use the assets. So you see, this lessor can also be called a landlord, while this lessee can also be called a tenant. But fundamentally, we will call them a lessee and a lessor. Now, when you have a lease or when you have a contract, how do you identify a lease in a contract? So that when you look at a contract, how would you know that there is a lease in this contract? You see, there is a lease in a contract if the lessee has the right to control the underlying assets. So where the party that is not where the party that is not the owner of the assets has the right to control the underlying assets, then there is a lease. So when we say right to control, right to control means two things. Number one, the lessee has the right to obtain substantially all the economic benefits from the assets. And two, the lessee has the right to direct the use of the assets. So these two really shows that there is right to control. Where the lessee has the right to obtain substantially all the economic benefit from that asset, and where the lessee has the right to direct the use of the assets. And for him to be able to obtain substantially all the economic benefits, see, this means that it is only the lessee that is using the specified underlying assets, and quote and unquote specified. The asset has to be specified. So that means a situation where a landlord or a lessor wants to lease an asset. Let's say he's a car dealer. He now tells the tenant or the lessee that, okay, you can come and you can pick any of these assets, any of these cars that you want. So every day you come, you can just pick any of them. That will not suffice as a lease because we don't deal with any of an asset. We need to know the specified assets just so that we will know which assets does the lessee has right to control. Is it one asset? Is it two assets? Is it three assets? Those assets has to be specified because we need to know that it is only the lessee that is using the specified asset. It has to be the only one using it. Otherwise, this first condition will not fly. And it must also be the lessee that is deciding what he wants to do with the assets. He has to be the one deciding what he wants to do with it. So, you see, this first point also shows that the lessor cannot substitute the assets. Cannot come and say he wants to substitute the assets. It will not fly. Cannot as well substitute. It's not going to happen. That is right to control. And Femi, please read this question for us, please.
BDO Transport Company entered into a 3-year contract with CML under which CML supplies BDO with 5 luxurious buses for the purpose of interstate transportation. CML owns the entire 5 buses specified in the contract. BDO determines the route taken for the interstate transport as well as the pricing. BDO can choose to use the buses for purpose other than the interstate transport. When the buses are not being used, they are kept at the premises of BDO and cannot be retrieved by CML unless BDO defaults on payment. If the buses are needed to be serviced or repaired, CML is obliged to provide a temporary replacement of the same type of buses required. Determine whether the above contract is a lease contract. It's a lease contract.
Okay. So they want us to identify whether the contract above is a lease contract. So let's look at it. I will say that the following indicates that the above contract is a lease contract. So BDO, he entered into a 3-year contract with CML, which CML supplies BDO with 5 luxurious buses. That's the first thing. So here, there is an identified asset, which is the 5 luxurious buses. There's an identified asset. So CML is the owner of the assets in this contract. We're told that BDO determines the routes that is taken as well as the pricing. That is also an indicator because that means that he directs the use of the asset. Since he's the one determining the route for the interstate, as well as the pricing of the transport service. Also, BDO can choose to use the buses for purposes other than interstates. So this is another point that also show that is directing the use. We're also told that they are kept in the premises of BDO and cannot be retrieved unless BDO defaults on payment. Even though whose premises the asset is located does not really matter. What we need to show is that is only the lessee that is using it. that is what is important. So I will not put that as a separate point. But we were told that if there is need for repair, CML is obliged to provide a temporary replacement of the same type of bus. So which also show that the assets cannot be substituted unless there is need for service or repairs of the buses. So the above points shows that BDO has right to obtain substantially all the economic benefits from the assets and has the right to direct the use of the assets. That's what this point shows. That's what it's showing us. And please read the second question.
Okay. BDO Transport Limited has recently made substantial cut to its interstate transport service.
What happened? Let another person read. I think Femi is out of the class.
BDO Transport Limited has recently made substantial cuts to its interstate transport service. It will now provide such services only in cases of great need. It has entered into a 2-year contract with CML for the use of one of its luxurious buses for the interstate transport. The luxurious bus must seat 45 people, but CML can use any of its 45-seater luxurious buses when required. The luxurious buses are held on CML premises and are only made available to BDO on request. Required. Determine whether the above contract is a lease contract.
Thank you. So let's say the following indicates that the above contract is a lease contract. So let's read it. So BDO has made substantial cuts, okay? Then I said it will provide such services only in case of great need. We're now told that it has entered into a 2-year contract with CML for the use of one of its luxurious buses for interstate transports. Okay, so this one shows that there is no identified asset because there is no specified asset here. Also, they said the luxurious bus must seat 45 people, but CML can use any of its 45 seater. Wow. So the CML, who is the lessor, it can also use any of those 45 seater bus. Oh. Those two shows that, in fact, the following indicate that the above contract is not, it is not a lease contract. One, there is no identified assets. Okay. Number two, CML can use, who is the lessor? You can use any of the buses. So the above points shows that the lessee does not have rights to obtain substantially all the economic benefits and does not have the rights to direct the use of the assets. So this one is not a lease contract in this case. Next question, please. Is Femi back?
Yes, sir. Thank you, sir. Network logged me out the other time.
Yeah, I figured.
WASPA enter into a 10-year contract with a telecom company, Tele, for the right to use three specified physically dark fibers within a larger fiber optic cables connecting Osun to Ibadan. WASPA makes the decisions about the use of the fibers by connecting each end of the fibers to its electronic equipment. For example, wiper power the fibers and decide what data and how much data those fibers will transport. Required. Determine whether the above contract is a lease contract.
Okay. So WASPA enters into a 10-year contract with a telecom company for the right to use three specified physically dark fibers. That means there is a specified asset here. There's an identified asset. Okay, within a larger fiber optic cable connecting ocean. Okay. WASPA makes the decision about the use of the fibers. That shows that I direct the use of the, okay. This one is there's a lease contract here. So the following indicates that the above contract is a lease contract. Number one is that there is an identified asset. And number two is that WASPA make decision about the use of the fibers. So it's deciding. So the above points shows that, let me just copy and paste. The above point shows that BDO, WASPA, has right to obtain substantially all the economic benefit from the assets and has right to direct the use of the assets. So, and that's that for this one. Let's read the next question.
Under a 4-year agreement, a car seat a car seat wholesaler, car seat, buy its seats from a manufacturer, under the terms of the agreement, car seat license its know-how to manufacture royal-free to allow it to construct a machine capable of manufacturing the car seat to car seat specifications. Ownership of the know-how remains with car seats, and the machine has an economic life of 4 years. Car seat pay an amount per car seat produced by manufacturer. However, the agreement states that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost of its investment in the machinery. The agreement states that the machinery cannot be used to make seats for other customers or of manufacturer, and that car seat can purchase the machinery at any time at a price equivalent to the minimum guarantee payment not yet paid. Required. Is there a lease in this agreement?
Okay. Is there a lease in this agreement? If you look at the first paragraph, it says under a 4-year agreement, a car seat wholesaler car seats buy its seat from a manufacturer. So we have an entity called car seats, who is a seller of car seats, a car seat wholesaler. And he usually buys this seat from a manufacturer called manufacturer. So this first paragraph has nothing to do with lease. All it's saying is that a company called car seats usually buys seats from a manufacturer called manufacturer. That's all this is saying. Now, the second paragraph says, under the terms of the agreement, car seat licenses its know-how to manufacture royalty-free to allow it to construct a machine capable of manufacturing the car seats to car seat specifications. Ownership of the know-how remains with car seats, and the machine has an economic life of 4 years. Now, from this second paragraph, we can see that car seat is now giving manufacturer his know-how royalty-free. Looking at this sentence, one would think that car seat is renting his license, okay, or his know-how to manufacture. And one would think that, okay, that this is the lease. But immediately they told us that it's royalty free. That takes it away. Since it's royalty free, that means there's no lease there. It cannot be free, he has to pay. So the lease element has nothing to do with this know-how because it's royalty free. So let's read on. Now, this know-how will allow manufacturer to be able to construct a machine that's capable of manufacturing the car seats to car seat specifications. So, so from here now, I can see that manufacturer will construct a machine, and that machine would be able to manufacture those seats in the way car seats want it, which is why car seat actually gave him that know-how or technique on how to manufacture the machine. Okay. When now to the ownership of the machine remains with car seats. No, sorry. Ownership of the know-how remains with car seats. So that know-how, car seat is the owner. And I've already removed the possibility that is renting the car to the know-how to manufacture because it's free. So there's no way lease will come from that angle. And the machine, and I said the machine has an economic life of 4 years. So from this paragraph now, the only take home from here is that there is now a machine that has been manufactured by Manufac using the know-how of cassettes. Okay. So the core thing from this paragraph is the fact that now Manufac has manufactured a machine. That's the thing here. There is a machine now. Now, the next paragraph then talks about cassettes pays an amount per cassette produced by Manufac. Of course, since he buys the seat from Manufac ordinarily, so he will pay now. He will buy, he will pay for what he has bought. They now said, however, the agreement states that a minimum payment will be guaranteed each year to allow Manufac to recover its cost of his investment in the machinery. So because Manufac has spent so much money investing, constructing that machine, so they now agreed that cassette is going to pay a minimum amount every year. So whether he buys seat or whether he does not buy seat, he will pay. He will pay Manufac a certain amount, just so that Manufac can recover all of his investments in getting that machinery ready. The last paragraph, they say the agreement says that the machinery cannot be used to make seats for other customers of Manufac, and that car seats can purchase the machinery at any time at the price equivalent to. Now, this paragraph is now showing us that this machinery is in question is used for only car seat alone. It cannot be used to manufacture seats for any other customer. So you see, there is a lease in the above contracts because there is an identified asset, which is that machinery. And two is that the machinery cannot be used to make seat for other customers of Manufac. So which shows that car seat, who is the lessee now, is the only one that has right to obtain benefit from that asset, because they can only use the machine to produce it for him. And also, car seats provided the know-how for the manufacture of the machine. So it's the one that even directs how the machine is manufactured. So obviously it's directing the use of the machine. So the above points shows that the above point shows that car seats has the right to obtain substantially all the economic benefit from the assets, and he has the right to direct the use of the asset as well. So he controls everything. He has right of control. And that's the solution to this. Okay.
Sorry, sir.
Okay, I'm with you.
Okay, in this case now, I think the machine is with Manufac.
Yes.
And so is is it the car seat now that is the lessee?
Yes.
Because I'm just looking for where the consideration comes in.
Yes, it's the lessee. They told us here that
So,
he pays a minimum amount to allow manufacturer to cover his cost of investment. So this is the lease rentals.
hmm, not. I, s- I'm seeing how about the agreement say that?
Who is the lessee? It's car seat now.
But I think it's Cassie that is still paying minimum money to
And now
manufac
it's the lessee
to
that will pay
enable
now.
manufac to recover.
Yes, now
Yes,
it's the
sir.
lessee that will pay. Who is supposed? It's the lessee that will pay the rent now.
Okay.
It's not the lessor. The guy has spent so much money to manufacture the machine on demand by car seat. The guy said he wants the car seat to be manufactured in a certain way. The manufacturer agreed. He manufactured the machine. And again, the machinery cannot be used for any other customer except for car seats. He's the only one. He's the only
And
one
now,
that
but now the machine is in care of a manufac.
yes, is the one is in his possession. You know, I told you that the possession of whom the asset is present does not matter. What we
Oh,
need to
okay.
establish is who is getting benefits from these assets, who has the
Mm,
right to control. So, right to control
mm,
has nothing to do with physical possession. It's
oh,
more
okay.
who is getting benefit from these assets.
Thank you, sir.
You're welcome. Now, lease term. So this is a non-cancelable period by which the lessee has rights to use the assets. Is a non-cancelable period over which the lessee has right to use the assets. This can include period of extension where the lessee is reasonably certain to extend. So this non-cancelable period can include period of extension where the lessee is reasonably certain to extend. So if we have an original lease period of 5 years and there is an option to extend for another 3 years, and the lessee is certain that it will extend, that means the lease term will be 8 years. The 5 years plus the period of extension, where he is reasonably certain to extend. And usually, the way you will know in the exam that the lessee is reasonably certain to extend is where it is favorable for the lessee to extend, where it is favorable for him to extend. is favorable, that the rent they will ask him to pay for those periods is small, that we want to extend that. I mean, it pays him to extend. Or it could also include period of termination, where it is reasonably certain that the lessee will not terminate. So if there is a contract for 5 years and we are told that the lessee can terminate, or the contract that can terminated within 3 years. So where it is reasonably certain that the lessee will not terminate, where it is certain that he will not terminate, then that means the lease term is still the original, will still be the original period in those cases, or in that case. Look at this question. It says a lease contract is for 5 years with lease payment of 100, with lease payment of 10,000 naira per annum. The lease contract contains a clause that allows the lessee to extend the lease for a further period of 3 years for a lease payment of 5 naira per annum, as it is unlikely the lessor would be able to lease the asset to another party. The economic life of the asset is estimated to be approximately 8 years. We are now asked that what is the lease term? So here, the lease term is the 5 years plus the period of extension, which is 3 years, bringing it to a total of 8 years. So our lease term is 8 years. Because in the original lease term, he was paying 10,000. If he decide to extend the lease for another 3 years, he will pay only 5 naira. Definitely he will extend. He would definitely extend. So the lease term is 8 years. Now, let's go to accounting for leases. Accounting for leases. So we are going to look at lessee accounting, and we are also going to look at lessor accounting. So when we are able to look at the two, then you'll be done with this topic. Now, lessee accounting. Don't forget the context here, that the lessee is the tenant. The lessee is only using the asset. He's not the owner of the asset. So how do we account for this lease? Knowing fully well that
I don't go register for that account class.
we know that you're here. Mute yourself. The lessee is only paying lease rentals and the asset is routine. He has the asset. So how do we register, how do we account for what is happening for the lessee? How do we account for it? And the major thing here is the money is paying as rent. How do we recognize it in our books? The asset he has in his hands that he is using, should we put it in our books or we should not? To determine that, we need to go back to conceptual framework that I taught you. One of the very first topic I taught you in this class. And under the conceptual framework, there is something called substance over form. Under chapter 2 of the conceptual framework, under faithful representation, substance over form states that if you want to faithfully represent a transaction, you must account for every transaction based on their economic and financial reality and not their legal form. Based on their economic and financial reality and not their legal form. Yes, this asset that the lessee has is not his own, but economically, financially, he's using this asset. This asset is making money for him. He is generating benefits from this asset. And if we go back to IAS 16 and IAS 38, the recognition criteria for assets in both cases is that it must be probable that future economic benefit associated to the asset will flow to the entity, and it must have a cost that can be measured reliably. Both criteria are met here for this lessee because he's getting economic benefit from these assets and he knows the cost. So, judging from accounting knowledge that you have had, then you should know that asset should be recognized by the lessee. So, at the inception of the lease, the lessee will recognize the following. I've mentioned one. I said you will recognize the assets, but we don't call it that particular asset. We actually call it right of use assets. And we intentionally call it this. IFRS 16 recommended this, calling those assets right of use assets, just so that we will know that this asset in question is a leased asset and the lessee does not own these assets. It's just to distinguish it from the asset that is owned by the lessee. So we call it right of use assets. So since it's an asset, let's say it debits it. What will be the corresponding credits? Who can tell me? What will be the other leg of this? Sorry?
It can be cash or liability.
It has to be a lease liability. That's what you credit. And if there's any portion he has paid, yes, cash too can come in. So I won't say you're wrong. But usually we have right of use assets and also lease liability. You see, the above entry is based on the concept of substance over form. You see, the key question is that, yes, we have established that the lessee should recognize right of use assets and lease liability, but at how much? Because you wouldn't expect the lessee to recognize these assets at the cost that the original buyer or the original owner bought it. So how would this be recognized and measured by the lessee? So we need to look at it. Let me start from lease liability, then I'll come to right of use assets. So measurement of lease liability. So at the inception date, or at the inception of the lease liability will be measured at the present value of unpaid lease rentals. At the present value of unpaid lease rentals. So we are saying that at the beginning of the lease, measure the liability at the amount you are owing, because it's a liability anyway. We want to know how much you are owing, which goes to show that if you rent an asset and you're supposed to pay 5,000 for the next 5 years, that means how much are you owing? 25,000. If you rent a building and you're supposed to pay 3,000 per annum for the next 10 years, how much are you owing today? 30,000. Some people will think that, why are we recognizing the entire amount now? Why don't we recognize what we are owing this year? You should know that accounting does not work that way. When you have an obligation to outflow, you recognize the entire obligation today because you want to know the position of your liability today. You recognize everything today. And that is why this liability will not be an exception. This liability will be how much are you owing? How much rent are you owing over the lease term? Recognize it. And remember that in reporting, we do not put future value in our books because leases are usually for their payment. They involve payment paid in the future. So that's why we need to get their present value. That's why we are talking about present value of unpaid lease rentals. So by the time you get that, you get how much you recognize at inception. Now, at the end of each reporting date, which is subsequent measurements, the lessee will increase the lease liability with interest and decrease the lease liability with lease rentals. So the above sequence must be followed where the lease rentals are paid in arrears. So where the lease rentals are paid in arrears, you would add interest to the lease liability first before you deduct lease rentals. And the reason why we are adding interest is because of we are unwinding discount. If you remember what I taught you in provision, that at the end of each year, whenever we discount to present value, we will usually unwind the discount. And we do that through interest. We do that through interest. So this sequence, you add the interest before you deduct the lease rental. If the lessee pays the lease rentals in arrears. However, where the lessee pays the lease rentals in advance, then it will decrease the lease liability with lease rentals first before it increases the lease liability with interest. This is the order that would apply if the lease rentals are paid in advance. For right of use assets, at the inception of the lease, the ROU assets, which is right of use assets, will be measured at costs. And these costs include, you might be wondering the cost care. Is it the one that did it buy the assets? So why is it recognizing at cost? Will it be the cost that the original buyer bought it or what? Remember that cost is relative. The original buyer, yes, his own cost is the amount he bought the asset. But as far as the lessee is concerned, his own cost is the amount he's paying to the lessor, the rent he will pay over the lease time. That's his own cost. So the cost will include the amount at which the lease liability is initially measured, meaning the amount we are owing. You will add the amount paid at the commencement date. And this makes sense, right? Because the cost of the asset should comprises all the money that the lessee will pay. So this first one is the one he has not paid, which is the lease liability, what he is owing. And this second one is the amount he has paid at the commencement date. Because for most lease, the lessor will not even allow you carry the asset if you don't do a deposit. They will say you should do a deposit. So that's why mostly you will find that there will be an amount paid at the commencement date. But they will ask you to do a deposit. So that gives us the complete picture of the costs of the assets from the lessee's perspective, which is the total money he has to pay. That's his own costs. Also, we are going to add initial direct costs, which is the cost of transporting the assets, cost of installing the assets, professional fees, all of those ones that we taught you in IFRS 16, all of that. Those are initial direct costs. And also, we are also going to add the commissioning costs, which of course is a future cost and will be the initial estimates of dismantling, removal, and restoring the site to its initial condition. That's the commissioning cost. When you add all this together, it gives you the cost of the assets at initial measurement. Initial measurement. Now, at the end of each year, the lessee will measure the ROU assets either at cost model or revaluation model. Who can tell me in this class what is cost model? What is cost model?
As cost minus residual value.
No. What is cost model? Ah, voila. Joseph, do you want to talk? I can hear you.
Okay. I will just say something.
Okay.
Cost model has to do with the recognition of the initial purchasing cost of an asset during depreciation.
No.
Cost is like cost minus accumulated depreciation.
Correct.
Oh, okay.
So cost model is cost minus accumulated depreciation minus accumulated impairment losses. While revaluation model is fair value minus subsequent accumulated depreciation minus accumulated impairment losses. If you don't know this one, I don't know. Really don't know because these are very basic things you should know. and that you should know very well that we did under IAS 16 and IAS 38. So you just depreciate the asset and get the carrying amount for right of use assets. And this is how the lessee recognizes that asset that he has leased. This is lessee accounting. This is all for lessee accounting. Do you have any questions now? Any questions? Now, there are some optional exemptions that is allowed by this standard, meaning that a lessee might not apply the above accounting approach or method if the lease is a short-term lease. If the lease is a short-term lease or the assets is of low value. So if the lease is a short-term lease or the assets is of low value, then you don't need to be recognizing right of use assets, lease liability. So if you have a lease of 6 months, you don't need to go through all of this. Just the rent you are paying, you can just put it in P&L. In fact, the common one where you pay your landlord every year, yearly, that's a short-term lease. You don't have to apply this because the present value thing will not work. So this type of accounting will apply where you are entering into a 5-year lease, a 10-year lease, a 3 years lease, a 2 years lease. Then you can apply all of these that I've taught you. Otherwise, just if you are paying just 1 year rent, just credit bank and debit prepaid rent. Then you can be amortizing your rent every month. But by the time you're paying more than 1 year in advance, then you should apply IFRS 16. Because IFRS 16 has also allowed those optional exemptions. That where the lease is a short-term lease, don't bother using all of this approach. Or where the asset in itself is of low value. And when we say low value, it should be an absolute amount of value of an asset. Everybody that sees the asset will know that this is a low value asset. If you now rent such an asset, you don't have to be doing all of this right of use. Whatever rent you are paying on such an asset, just put it to P&L as expense. Don't go through all of these processes. Probably maybe you rent a printer or you rent a router or a laptop that the value is low. You don't have to go through all of this. So they have exempted. There's an optional exemption. Except if you decide you want to do that, it's okay. Why not? It's an optional exemption that is allowed. The next one is the lessor accounting. The lessor is the owner of the assets. He owns the asset. So the lessor must identify the classification of the lease to properly account for lease arrangements. So, and the classes of leases that we have finance lease, and we have operating lease. So finance lease is a lease where the lessor transfers the substantial risk and reward attributable to the assets, while operating lease does not transfer risk and reward attributable to the assets. So finance lease transfers substantial risk and reward attributable to the asset. Operating lease does not. It does not transfer any risk and reward attributable to the assets. So how will you then know that risk and reward has been transferred? That takes us to indicators of a finance lease. How will a lessor knows that risk and reward has been transferred? This will show, number one, is that there would be a transfer of ownership of the assets to the lessee at the end of the lease term. So ownership will be transferred to the lessee at the end of the lease term. This is an indicator that we are dealing with a finance lease. Number two, there is a purchase option. Since we are going to transfer ownership to the lessee at the end of the lease term, you'll be required to pay a small amount to get ownership. And that's a purchase option. And this purchase option, in this case, it will be so insignificant. It is insignificant compared to the fair value of similar assets at the exercise date. At the date is supposed to, which is at the end of the lease term. Now, when you compare the money they ask him to pay for the assets, the purchase option is so small. If you compare it to similar assets in the same condition, you say, this one is a giveaway. That they just ask him, shall pay something and take the asset. Then you know that you are dealing with it was a finance lease. Dealing with a finance lease. Number three is that the lease term is substantially equals the useful life of the assets. So by the time you have a lease term that is substantially the same as the useful life of the assets, then you know that you are dealing with a finance lease. Or where the lease liability, which is also similar to the PV of lease rentals, is also substantially equals the fair value of the asset, then we are most likely dealing with a finance lease, where the lease liability or the PV of lease rental is almost equal, almost the same as the fair value of the assets, or where the assets is a specialized asset that only the lessee can use it without significant modification. So where the asset is a specialized asset that only the lessee can use it without significant modification. That also shows that this asset is a finance. We are dealing with a finance lease arrangement. So these five should be present for us to establish that we are dealing with a finance lease. Now, when we have identified that it is a finance lease, then how do we account for finance lease? How does the lessor account for a finance lease? So, since the lessor knows that he would have to derecognize the asset from his books, in fact, since the lessor knows that he would transfer ownership, that the asset will not belong to him again at the end of the lease time. So, I mean, right from day one, the lessor should derecognize the assets from the inception of the lease and recognize a net investment in the lease, or what we call lease receivable. You will just recognize a lease receivable. So the lessor should recognize the asset from the inception of the lease, and you will now replace that with net investment in the lease or lease receivable. So how does it determine that net investment in the lease, or what we call lease receivable? You will do the present value of the unpaid lease rentals, and also you will then add present value of unguaranteed residual value. If we add these two together, then we will have gotten net investment in the lease or lease receivable. So this is a representation of what the lessor is expecting from this entire lease arrangement. And it makes sense because for him, he's expecting unpaid rent, and also is also expecting unguaranteed residual value. You see, usually usually the lessee will, in some cases, the lessee might pay residual value to the lessor. And this lessor, and this residual value, there's a portion that might be guaranteed. There's a portion that might be guaranteed in the sense that he has already committed to it that, okay, at the end of the lease term, I will give you this social amount as the remaining value of the asset. So the way it works, that guaranteed residual value, it's usually included as part of the rent he will pay. He will just spread it. He will not wait until the end of the lease term before he pays. He will just include it as part of the unpaid lease rentals. He will include it as part of the rent he's paying. So it will be part of what the lessor is expecting. However, in some cases, the lessor might believe that he can get much more than what the lessor is guaranteeing. I say lessor, lessee, in that he still has the liberty to sell the assets and make some more money. So that additional money is expecting, we call that unguaranteed residual value, even though he's not sure whether he will get, but since he's expecting it, it's part of his lease receivable. And that's why he's coming here as part of what we recognize. And this at the inception of the lease. At the inception of the lease. Now, at the end of each reporting date, we are also going to increase, let me call it NII, or let me call it increase the lease receivable with interest and decrease the lease receivable with lease rentals. So we're going to increase the lease receivable with interest and decrease the lease receivable with lease rentals, just like we do for lease liability also. And this is everything for finance lease. This is everything for finance lease. Now, still under finance lease, if the lessor is a manufacturer or dealer lessor, the same reason we increased, somebody is asking why are we increasing the interest? The same reason we increased it here is exactly the same reason why we are increasing it here too. Present value. Whenever you present value, you would unwind the discount at the end of each year. And that's why we are adding this one. Just like I've explained for lease liability. It's the same explanation for that. For this one too. I can see another hand. Femi.
Yes, sir. I just wanted to know that, when you were talking about lessee, you say you can pay in advance and arrears. So I wanted to know, will it have any effect in the account of the, is it going to have effects in the account of the lessor if he's paying in advance or in arrears?
The same thing will apply here too. Same thing will apply here too. So this is, if it is paid in arrears, it will come like this. If it is paid in advance, it will be the reverse, just like we did here. Just like we did here. It be the reverse for this one. Just that it's common you have arrears payment for lessor and all of that too. That's why I just restricted it to this, but it's the same thing will apply. Since the lessor accounting is like a mirror image of what the lessee is doing, so almost the same thing as happening there will also happen here too.
Okay, sir.
Mm.
Okay. Do we have any other comments before I do some other things?
So for the indication of finance leasing, the indicator, can you scroll down? No, we have said there will be a transfer of ownership of the assets. Is it a must that the asset must be transferred, like to the lessee at the end of the contract
Yes.
before we can indicate it as a finance lease?
Yes, it is. It's
Okay, what
compulsory.
if it's otherwise? What if it's otherwise? Is it operating lease?
Yes, that makes it an operating list. I mean, that's just what it means. If it doesn't meet these conditions, then automatically becomes an operating list. Automatically. Okay. Now, if the lessor if the lessor is a manufacturer or dealer of that item, then in addition to recognizing net investment in the lease, the lessor is required to also recognize a gross profit if he's a manufacturer or dealer of that item. In the sense that if that's the item he sells in his ordinary course of business, if that is the item that he sees as his inventory, he is now leasing out such an item, then he is required to also recognize a gross profit in addition to doing this, which shows that this standard is just trying to block some loopholes. There are some companies that might want to probably maybe understate their profits. They might want to understate their profit, that they would not want to recognize an item as revenue in their books. They will say they leased it out under finance lease, where they would remove that item from the assets and only recognize a net investment in the lease. And that's it. But in order to avoid that, if that's the item, that item that you are leasing is the item you sell in the ordinary course of business, then the lessor must recognize a gross profit in addition to the lease receivable he has recognized. He must also recognize a gross profit. And how do you determine gross profit? It's simply sales minus what? Minus cost of sales. When you do sales minus cost of sales, that gives you gross profit. And what's sales in this context? You should be looking at the fair value of the asset, right? How much you can sell the assets. But in this case, since he's expecting something from this arrangement, but here he's only going to consider the PV of unpaid lease rentals. So it takes these two and pick the lower of them. So it will consider the lower of fair value of the assets and PV of lease rentals. It picks the lower and recognizes that as revenue. So one would expect that it should be comparing this selling price of these assets with the lease receivable, because that's what is expecting. That's the consideration expected. That's what should sound more like revenue. But the reason we did not consider the whole of this is because of this unguaranteed residual value. IFRS 15 will not allow a figure like this to be revenue because it is not probable that this lessor will receive it, will collect it. It's not sure. It's not sure. It's unlike the guaranteed. This is unguaranteed. And that's why it will not come in as revenue. So that's why we only picked the PV of unpaid lease rentals. So the cost of sales will be the cost of that asset minus the PV of unguaranteed residual value. So by the time you'd do your mathematics, you get this. So the cost of the asset minus PV of unguaranteed residual value. So we are saying that if we are not allowed to add it to revenue, for it to have the same impact on our profits, then why not remove it from our cost of sales? This is what I'm saying. Look at it. So let's assume the PV of unpaid lease rental, the rent that is expecting, let's say is 50. And the PV of unguaranteed residual value, let's say that's 10. And let's say the cost of the assets, let's say that's 30. You know, ordinarily, our gross profit should be our sales, which is the PV of unguaranteed residual value plus the PV of lease rental plus the PV of unguaranteed residual value, then that should be 60. Then the cost of the assets, that should be 30. Then ordinarily, we should have had a gross profit of how much? Of 30. But we are saying that IFRS 15 frowns at adding something like this to to sales. So we say remove it. So this becomes 50. But you say we can come and remove it from here. Then this becomes 20. So if you do 50 minus 20, our gross profit still remains 30. So what we are doing with this PV, we are just playing around with arithmetics here. So, and that's the only reason why it's coming here. So when you're reading and you see minus PV of 1 guaranteed residual value, and you're wondering, you're just playing around with mathematics here. So instead of adding it here, but IFRS 15 will not allow the addition, then just so that it still has the same impact, then come and remove it from here. That's the reason why that is coming there. And that is pretty it on manufacturer or dealer lessor. So in addition to the lease receivable, it will also recognize a gross profit. And still under lessor is that if it is not a finance lease, then it's definitely an operating lease. It's definitely an operating lease. So what is an operating lease? We already know that it's a lease in which the lessor does not transfer risk and reward. Then how do you account for that? Very straightforward. So the lease rentals should be recognized. In fact, let me call it the lease receivable or the lease rentals receivable should be recognized to profit or loss on a straight line basis. On a straight line basis. Is that straightforward? So for operating leases, we want to see an amount that you pay as rent in P&L, but you have to make sure that you recognize equal amounts every year to P&L. Equal amount to P&L every year. That is what we mean by on a straight line basis. On a straight line basis. Equal amount of rent should be recognized to your profit or loss. And that is the entire principle for leases, IFRS 16. Tomorrow, we are going to solve I already have all the questions here. So we're going to solve questions on all of this, and that will be the end of leases. But in our morning class, we are going to be doing IAS 8 accounting policies. We are going to use that to resolve accounting policies. So what I'm trying to do with you guys, which might work very well for you, is that I want to see the possibility of finishing up your syllabus by the end of this month. If you are consistent with what we are doing, it's very possible. And why it is possible is that in those Sunday classes, in September now, I think we have 2 or 3 Sundays that I can use for you guys. Let me see. 1, 2. Oh, no, I only have 2. Okay, 1, 2, 3. I only have 2 because I don't have 3. I have 2 that I can use with you guys. So those 2 Sundays, we can use it to cover like 4 standards: IES 20, IES 40, IES 23, IFRS 5. Those 4 standards. And in our normal classes, these 2 classes we have, we would start group accounts. So that means next week, Saturday, we should start group accounts. And group accounts should take me five meetings. We're going to meet to take 5 classes to finish group. If we can finish it in 4 classes, that would be perfect for us. Then, so what we'll have left will just be some few standards and ratio, like ratio analysis, EPS, IS 21, which one again?
IS
Maybe
7.
IS. And statement of cash flows too. Statement of cash flows also. Yeah, that one is very, 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 very important. So that is all we have left with you guys. So let's see how far we can go in September. So if we can finish up in September, that's fantastic for you guys, and to help you to have more time to prepare. So in October, all of these plenty classes we are having for FR, we will not have it anymore. Maybe in a week, we'll just meet just once in a week, because we'll have very little to cover, very little. So I'll give you time to be reading, to be solving past questions, solving questions. So the time you have is not for you to now say, I have time, I have no. So why I'm making effort is just so that you finish up early and you have enough time to sit down yourself and read, because that's what will make you pass. Because all of these things that I'm teaching you, it has no value if you don't read it. You forget. That's why I was asking the difference between what's cost model. That's a very basic thing. And none of you can really tell me very well, convincingly, what it is. Femi was even saying cost minus residual value. Really, you need time to go and read very well. So that's what I want to achieve with you. Study. I want you to have much of your October to study for that exam. November, maybe we can then do some revisions together again to awaken a lot of your, in fact, if you are meeting in that October, maybe ratio, cash flow, we'll be solving question on published, stuff like that, that will apply most of all of the things you have learned in July, August, September. So this month is very crucial for us. Let's make the sacrifices this month so that things will be easier on you as we move on. So I'll see you guys tomorrow. Thank you very much. Have a good evening.